Hello everyone, and welcome once again to the channel. So you are thinking of getting into real estate investing? Great! It can be a wonderful vehicle for building wealth. But today, we're not talking about the glitzy success stories that you hear about on social media. We're talking about the harsh reality of how most newbies blow it. And the thing you most want to remember is that failure rarely results from one giant killer error. It's more likely a series of tiny, preventable screw-ups that snowball into a chain reaction. Think of a line of dominoes. We're going to discover those initial dominoes so you don't have to let them fall to begin with. So why are these mistakes all so dumb? They actually all fall into three big categories: having a horrible plan, making huge money mistakes, and simply being sloppy with the operational and legal minutia. And the common thread that runs through them all is a simple failure to prepare. People try to save money a little bit here and there, or save time a little bit here and there, and spend an absolute fortune in the end. Just take these numbers. Overbidding and going crazy can cost you $20,000 of equity on day one. Not doing a $500 inspection can show you $10,000 in surprise repairs you never saw coming. Being cheap and doing it yourself can make one tenant turnover cost you 10 grand. The math just doesn't work. Being frugal now will make you poor eventually. Alright, so let's dive into mistake number one. And this is the big one: deciding on emotion, not data. This is likely the most common and most costly trap for first-time investors. When this much money is hanging in the balance, our brains start messing with us. The most typical one is loving a home. You see it, you imagine your life in it, and before you even realize, you need to have it. This is what is called emotional attachment, and it pushes you to overbid and overpay because you love it and not just because the numbers fit. And then anchoring bias, where you're anchoring on one piece of information, like the first price you hear, and you ignore all the red flags that come later, like a disastrous inspection report. And then we have FOMO, the fear of missing out. You see a competitive market, you worry, and you rush to secure a deal. This is where humans behave silly and give up their right to home inspection. You're basically signing up for a surprise box of problems simply because you fear that you'll miss the deal. So what does happen when you buy with your heart, not your head? The immediate impact is that you overpay. You instantly murder your potential return on investment before you even get started. An overpaid property must perform miracles in terms of rental income or appreciation just to break even. You're often running with a backpack of boulders. And then there are the sneaky issues. Because you're so in love with how much you love the cozy fireplace, you completely neglect that the slab is cracked, the zoning won't allow you to install that rental apartment you dreamed of, or the HOA has ridiculous regulations. These aren't small issues. They come back later as enormous, unbudgeted expenses that will put you deep into financial trouble. Prevention plan is simple, but requires self-control. You have to make an informed decision. You have to fall in love with numbers like the cap rate, the cash-on-cash return, and the net operating income, and apply a cooling-off period while conducting due diligence. Let that initial high wear off so you can make a dispassionate, logical decision with your funds. Which leads us nicely to mistake number two: skipping or rushing your due diligence. Due diligence is not a suggestion. It's your mandatory investigation period. It's your one chance to inspect everything you think you know about the property. Shortchanging this is a gambler's risk, more often than not triggered by impatience. Number one, never ever skip the professional home inspection. It is your strongest protection against purchasing a money pit. It indicates flaws that may cost tens of thousands to fix immediately. Number two is obtaining a title search and title insurance. This ensures that the person selling you the house actually owns it free and clear, and there are no hidden liens from a contractor or a previous owner that you would suddenly find yourself inheriting. Number three, zoning confirmation. You must verify that your intended use of the property, whether a rental, a renovation, or a short-term rental, is actually legal in that zone. You don't want to end up with a massive penalty or have to undo everything you've accomplished. And number four, inspect the local market. Take a look at the comparable sales, understand the true vacancy rates, and even look at crime patterns. This keeps you from paying too much or speculating on what kind of tenant you will attract. Okay, mistake number 3 is a stealthy killer, underestimating your expenses and savings. This is the most common reason why a profitable-looking deal on paper turns into a nightmare in reality. Freshmen get tunnel-visioned about the mortgage and completely forget all about all the other ownership costs. They overlook indirect costs of operation like property taxes, insurance, management fees, legal fees, and utilities that the owner might be charged for. And then there's the myth of vacancy. Baselining your books on 100% occupancy is a fantasy. People relocate and vacancies remain empty. Your fixed costs, like your mortgage and taxes, don't just go away because nobody is paying rent. And then there's the doozy, capital expenditures, or CapEx. These aren't for the little fix the leaky faucet type things. This is the big stuff. New roof, full HVAC replacement, resurfacing the driveway. These are big, uncommon expenses that cannot be avoided over the life of a piece of property. So how do you pay for these gigantic CapEx bills? You can't just hope they don't happen. You must provide for them. That is where the CapEx Reserve Fund comes in. Think of it as forced savings on your building. When you buy a piece of property, especially a cheap one, there is generally a lot of deferred maintenance. You might find yourself with $20,000 or $30,000 worth of repairs the first year alone. Unless you have it saved in a reserve fund, you're hosed. The trade practice is to set aside 1% to 2% of the value of the property every single year, just for these high-priced items. So if you're working with a $300,000 property, you're setting aside $3,000 to $6,000 per year straight off the top into this savings account. And be conservative with your finances at all times. Plan for a 5% vacancy rate, not 0. Expect your maintenance costs will be on the high side of estimates. This is a financial cushion so that when life happens, and it will, it's inconvenient, not catastrophic. Mistake number 4. It's all about the numbers, abusing your numbers and over-leveraging. Too many amateur investors dive in without actually having a clue how to measure the quality of a deal. They're obsessed with the gross rental income, or they're just betting on prices going up. You must understand a couple of critical metrics. The cap rate gives you the unlevered return, the normalized performance of the property before you ever obtain a mortgage. But a mistake that individuals often make is to see a high cap rate and think it's a fantastic deal, without accounting for your cost of loan. Then, cash flow. This is the single most important figure to a long-term investor. It's the actual cash you have left over when you collect the rent and pay every single expense, including your mortgage. If this number isn't always positive, you are most definitely in a bad situation. And cash-on-cash return tells you what kind of return you're getting on the actual cash that you're investing into the deal. The killer fault here is prioritizing appreciation over cash flow. Bets on the market just going up and rescuing you are speculation, not investing. Your property has to be an independent business generating positive cash flow. Or the moment you have your first empty unit, it is a personal hassle. And that brings us directly into the debt trap, or over-leveraging. Levering too much debt or debt that is not right for you removes your buffer. When one's home is highly leveraged, it has no room for error. Consider this. If your mortgage repayment gobbles up nearly all of your rent money, what are you going to do when you have only one vacant month? Or the water heater goes out? Your cash flow in the negative now, and you must dip into your own pocket to make up the difference. That places you in a very precarious financial situation. If a big repair overlaps with a vacancy and you are not holding reserves, it can be a full-blown financial crisis that will force you to sell the property at a loss or even drive you to insolvency. Debt is not a toy. It is a tool. To abuse it is one of the fastest ways to fail. Number 5 is a strategic error, choosing a strategy that will not work with your resources and goals. Many new investors choose the sexiest or the fastest strategy without actually knowing what they have to play with. The classic mismatch is between fix and flip and buy and hold. Fix and flip is great for a rapid profit, but it needs extremely high initial capital to buy and rehabilitate, specialized building skills, and an enormous amount of time spent on project management. And if you flip within a year, those profits are taxed at higher regular income rates. Buy and hold, on the other hand, is about creating wealth over time. It's about steady cash flow and long-term growth. It requires somewhat more temperate capital and is much more passive, and you pay lower, long-term capital gains taxes. An extremely valuable part of your plan that everybody tends to overlook is your exit strategy. You need to know it before you buy, how and when you will get out. When the property gets to a certain price, or when your return goes below a certain number, "I'll sell when the market's good" ain't an exit strategy. It's a fantasy. Mistake number 6 is the lone wolf approach, trying to do everything yourself and not investing money in professional help. Real estate investing is a team sport. Trying to cut costs by doing everything yourself as agent, attorney, accountant, and property manager is a surefire recipe for making expensive amateur mistakes. You need an investment-focused real estate agent, not a house seller. You need an agent who analyzes deals in terms of cap rate and cash flow. You need a real estate attorney to scrutinize contracts and get your legal entities set up properly. You need a real estate tax planning expert CPA. And you simply must have a professional property manager for efficient tenant screening and ahead-of-time maintenance. The money you imagine that you are saving doing it yourself is an illusion that will burst the first time you have a bad tenant. And that's where the tenant turnover crisis enters. This is the single largest threat to your cash flow. Poor management leads to poor tenant screening, which leads to evictions and constant turnover. The cost of a single tenant turnover is staggering. If you total lost rent, eviction court fees, cleaning, and fixing things up to get the unit ready for reoccupancy, you can be readily discussing $10,000 per incident. And the vacancy rate doesn't lie. A quality property might have a supposed 5% vacancy rate. But with poor management, it can just go up to 20% or higher in no time. A deal that was solid on paper will totally fall apart if you're having to contend with regular evictions and empty units. Having a professional property manager isn't a luxury. It's a necessary business expense that keeps your investment intact. And finally, mistake number 7, ignoring your legal structure and liability. With real estate, there are risks involved: slip and falls, tenant troubles, negligence claims. Without a good legal structure, your own personal assets, your house, your savings, your car, are at risk. The key to asset protection is a well-established LLC. But don't form a cheap online LLC. You have to maintain it. Your business and personal money kept strictly separate. Otherwise, a judge will pierce the corporate veil, and you're personally liable, so a lawsuit can ruin everything you have. You have to be a landlord-tenant law specialist, too, which varies from state to state and even within cities, and ranges from how you legally evict the person to security deposits. And you have to maintain your property and any additions you make to it strictly in compliance with local building and zoning codes. Ignorance of the law is never an excuse. The cost of professional legal setup and compliance is always less than the cost of personal liability exposure in a negligence lawsuit. It's that simple. You have to master key legal areas: fair housing laws to avoid discrimination lawsuits, building codes to avoid massive fines, and maintaining your business entity so it actually protects you. And remember, these legal risks are further exacerbated by other mistakes. If you hired a terrible property manager, mistake number 6, and they don't maintain the property, and something causes an accident, the lawsuit will test your legal framework from mistake number 7. The mistakes stack up, and the house of cards collapses. Another plus mistake is not performing proper local studies. You will hear it over and over again. All real estate is local. That is to say that achievement is associated with familiarity with the micro market of a local community, as opposed to national headlines. National trends set the stage, but they won't assist you in making a specific buying decision. You need micro-market intelligence. Are there approvals for new developments on the horizon that could change supply and demand? Has there been a recent change in zoning? You need a local review. What are the actual rent comparables on that specific street? What is the actual active vacancy rate? What are the crime patterns and school quality? And you must put yourself in the tenant's shoes. Are you offering what they want at a price they will pay in that area? Not doing this local study sets you up for higher turnover and lower profit. And don't snooze on your financing. Your loan is an expense structure that significantly impacts your long-term bottom line. Taking the first loan proposal that is presented to you can decimate your margins over 30 years. You need to compare all your options: traditional loans, portfolio loans, commercial debt. Consider their interest rates, their terms, their origination fees. And you need to weigh seriously the cash versus financing question. Cash payment in full saves interest, certainly, but it ties up a huge amount of your liquidity. The money could be invested elsewhere, or even used as an emergency pool. Often, especially when rates are decent, financing some portion of the purchase and allowing the rent to service the payment makes for a more sensible approach to portfolio building. This is the most valuable lesson, and that is that these errors are multiplicative. They don't stack, they multiply and feed on each other. Look at an investor who is most highly leveraged. That's mistake number 4. They buy a property on emotion and overpay. That's mistake number 1. And they do not plan for capital expenses. That's mistake number 3. This is a system with literally no tolerance for mistake. So when the inevitable does happen, a pricey eviction because of poor management or a significant roof repair, it's not just one problem. It's the final trigger in a chain of events that leads to an entire economic collapse, which causes a sale or worse. One mistake makes you vulnerable, but a few all at once can knock you out. So let's take a quick tour of the 7 deadly mistakes you must avoid. Emotional buying, overpaying because you fell in love with the property, skipping due diligence, gambling by not conducting adequate inspections and checks, miscalculating expenses, underestimating the true cost of ownership, prioritizing appreciation, guessing at the appreciation of the market instead of insisting on positive cash flow, strategy misalignment, choosing a strategy that is not appropriate for your skills, time, or capital, operational neglect, trying to do it all on your own without a professional entity, legal exposure, exposing your personal assets to lawsuits. So what is the recipe for success? It's adopting a professional protocol. First, establish a clear strategy and quantifiable exit plan before you ever even glance at a property. Second, develop a conservative financial model that budgets for actual expenses, vacancies, and hard CapEx reserve. Third, insist on careful due diligence every single time. No exceptions. Fourth, gather your professional team, a specialized realtor, a real estate attorney, a CPA, and a property manager. And fifth, protect your investment with a robust legal entity and appropriate insurance. Ultimately, successful real estate investing is not accomplished through finding some magical, perfect deal, but by diligent attention to process, figures, and professional risk avoidance. You have to treat it like the business that it is, and not a hobby. Make decisions based on facts, not feelings, and invest in experience and proper form up front. The cost of professional advice and conservative planning is always less than the cost of the amateur mistakes we talked about today. It's about making sustainable wealth over time by getting the process right. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.